Welcome back, folks. This is Billy, Sean, and our special guest, Jake Johnstun. Today we're talking about taxes, everybody's favorite topic. I mean, don't you love taxes, guys? It's something that we're all interested in how to avoid. I think let's just do that because this conversation is going to be dialing in on the new tax laws, some things that came out of the latest legislation from the big beautiful bill. Let's just call it what it is, how it's been labeled. And Jake's here to go through all the things that are happening in the world of tax and maybe some of the interesting parts of it, of things you all might want to hear and take note of and maybe implement in your own life to capitalize on some of these opportunities to avoid taxes where possible. So Jake is a veteran in the tax accounting industry. He is a CPA, 31 years of experience, and he owns a company called Integrative Tax Accounting right here in our backyard, South Ogden, Utah. So thanks again for being here, Jake.
You bet.
Thanks for having the time to spend with our clients and us and being on the show. So maybe we'll just jump in. I wanted to ask you some questions about this latest legislation that was passed by Congress here a couple months ago. Can you talk about some of the deductions that are now available for just the regular American hardworking people, some of the things that they might be able to take advantage of as they go into this year end and be prepared for taxes come next year?
Yeah, we can talk about those. Did you want to talk about the self-employed people too, or W-2? Or?
I think both would be
I
beneficial.
mean, yeah, our clients.
I'm going to have you scoot your mic up just a little bit.
Yeah, we'll get a little louder there.
Okay.
Good. There you go. I can hear you better now.
Stay close to that mic.
Okay, perfect.
People want to hear what you got to say.
I think some of the things we saw, one of the bigger things are the depreciation, getting back to 100%. That's always a nice thing with special depreciation. That's always kind of one of the bigger things. Biggest things in depreciation we saw that I think could be impactful for some of our local businesses is being able to fully depreciate in the first year new buildings in the construction or manufacturing industry, which we haven't got regs on. So we're wondering how that's going to hash out. So, if we were dealing with people that were in their backyards building pole buildings for, horses or holding construction equipment or something like that, if it had a foundation, we were having to take those as commercial property over a long period of time. And now with OB3 is what we call it in my industry. One big beautiful bill is OB3. So OB3 allows us to take now that deduction in 1 year, which is pretty massive. If you have a trade or business and it can be tied into that industry, which is not fully disclosed because we don't have treasury regs on it, and you're building a building for holding equipment of some sort on your property, then you'll be able to take the entire thing in 1 year, which is probably going to affect your clients.
I mean, it's to incentivize growth, right? I mean, that's a huge, huge deduction for a business owner out there. And to get that depreciation all in 1 year is massive.
Yeah. Let's say you build a barn dominium of some sort or something, and you spend $500,000 on it. You're going to be able to take $500,000 this year. So that's going to be.
How's that differ from what it was before?
Well, before you're going to be, you're going to have it over 31 and a half years. You could get a cost segregation on it, and break it down, but you're still going to have this large portion of the building that's going to be over a long period of time.
Really to stimulate growth and to encourage investment, right?
Right. But if you've got someone that wants to improve their property, right, and they're moving in and they're going to be using it for their trade or business, and it's going to fall into the specified trade or business that's under this law, then they're going to be able to write off the entire thing in 1 year, which is pretty massive.
Yeah, that's nice. Do you still have the option to do either or though?
Oh, sure.
Could you go over a longer period if whatever the tax situation maybe made more sense to do that way?
Absolutely.
Okay.
Yeah.
Talk about maybe the vehicle option. I know there's some discussion around that. A lot of people, and this could be a real buzz item from our show, the people that want to purchase a car may be able to deduct that interest on a vehicle.
Yeah, that'll be, and you're going to be able to deduct up to $10,000. There are some restrictions on that, of course. The U.S. assembled vehicle, so it's got to be U.S.
only, America first, right?
Yeah. So that's an issue. The phase outs on those are, I believe 200,000. and that might be that might get a lot of people that are going to do it out of the picture. But you're going to have to finance those vehicles and within this year, right, going forward. But yeah, you'll be able to deduct up to $10,000 on a U.S. assembled vehicle, so that's gonna be nice.
Now, if you didn't finance it and you just bought it and it was part of your business operation, we're going back to that depreciation where you could depreciate the vehicle instead.
Yeah, I mean, but if it's a business vehicle, you're going to be able to deduct the interest anyways,
Okay.
right?
So you're talking about personal vehicle purchases.
Yeah. So
Now we're not telling everyone to run out there and just load up on a $200,000 car loan or something like that. But if you are going to borrow it, you might want to consider American made. I think that's the whole point of
That's
it.
the point.
U.S. assembled,
U.S. assembled.
right?
So it could be a Toyota, but assembled in the U.S.
Yeah, and we were talking about this because we're going to have to figure out which cars are U.S. assembled, right?
I mean, I swear I've seen stickers on cars
Gotta be a
that is
sticker.
assembled.
Assembled.
yeah.
in
So-
the
Yeah.
US.
You
So
see it
think-
on your clothes you buy made in
Yeah,
China.
true.
So the income limitation is 100,000 single and 200,000 joint. So if
Okay.
you have people that make over that amount, they're not.
This
gonna
is
get
a
the non-issue.
Mhm.
But when you have a U.S. assembled vehicle, we've been talking about like what are U.S. assembled, and we knew for a while. I know the BMW X5
Mhm.
was assembled in the United States, and I don't know if it still is or not. But we're gonna have to now go back and find all those.
Yeah.
So we'll find out.
My family had a Ford dealership. I think we've shared that before. And I swear a lot of those Fords were assembled in Mexico.
Oh,
But
Yeah.
I guess now it's a big incentive to maybe move it back to here. I think that's the whole point of this big, beautiful bill. A lot of it is America first, bring production back,
jobs.
jobs.
Yeah, it's really about the jobs and
Yeah.
Yeah.
keeping the cash here, not in another country. Speaking of some incentives for regular people as well, this new Trump account.
Yeah.
Talk about that.
That's an
Get
interesting.
close to the mic so we can everything.
Sorry. Yeah. No, that's an interesting one because there are IRAs that'll be
Mhm.
for children under 18 years old. They're $5,000 a year is what
The limit.
the limit will be on
Mhm.
them.
So for a child that's born anytime in the next year, or I guess could be beyond that.
Child born after 12/31 of 24
Okay.
and before January 1st of 29.
Okay. So it expires in 29,
Yeah.
end of 29.
And they'll get the free $1,000, right?
And then they can contribute an additional
On top
four.
of that.
They can, they can contribute the additional, and then also, but there are some of the interesting things about it is they have to be in an ETF or a mutual fund that tracks the S&P 500,
Mhm.
which is, that's very direct. You know what
Yeah.
I mean? Like that's, I wonder about that. Maybe they're just trying to dissuade foreign investment with it or something. I don't know.
Maybe.
I
Could be
mean, I
that.
think it's just kind of given the opportunity. Obviously, U.S. business is S&P 500. Obviously, U.S. business is the 500 largest, but also it's hard to argue against the track record of the S&P 500
Yeah.
over the
absolutely.
last 100 years or so. The performance on it.
Yeah.
I often ask this, like, what would happen if our Social Security money had been invested in something like the S&P 500? Because I've seen some, and I've actually done some calculations myself.
Didn't
I
you?
love to do numbers, but if you take, like, for example, the average 55-year-old or so who's been paying in Social Security his whole life, his or her whole life, up to a point when they're nearly ready to start taking Social Security, they may have contributed or had contributed on their behalf from their employer $600,000 or so. And they'll have a withdrawal amount over their lifetime, depending on when they start that distribution, of a certain monthly benefit. Okay, let's call it $2,500 a month, $2,800 a month. However, if you'd invested that same amount on a monthly basis over those same 40 years or so, if work life, you'd have over $3 million in
Your own
retirement
money.
assets. Yeah, your own money that you can then start taking distributions from. And this is just back testing the returns that you would have had. This isn't me showing speculation or maybes. This is actual returns over a 40-year period. So it's been a lot more value and a lot more annual. Because the way we run our financial planning company is you typically have a rate of return that you can allow for. So between a 4 and a 5% withdrawal rate. So if you figured 5 for round numbers on 3 million, you figured $150,000 a year in distributions on that. And that's Social Security. That's pretty good.
A lot better than your 2,800.
Way better than
Yeah.
that on the Social Security piece. I don't know. I'm just giving you some back
Billy, you need to
information.
run for a seat and propose that.
I've been a coach. I've been shot with arrows. I've been
Called at
vilified,
midnight.
called names. I've been
Battled some parents.
9 years a coach. You've heard all those stories.
I know. Yeah, I lived them. Because I would know if you got one of those calls in the morning, I'd see you coming in. I'd be like, not today.
There's about
We're
20
leaving Billy alone today.
20% of those comments are positives, and then the other 80% are how terrible you are and how dumb you are. But
Yeah.
let's get back
to taxes, not your personal woes.
Yeah,
Yeah.
taxes.
Well, I wanted to correct one little thing.
Yeah.
Remember, the $1,000 did not go towards the contribution, so it's 5 plus the 1.
Oh, so you could
it's
really,
great.
I mean, yeah. That I like that. And
Yeah.
and I also read in here, no distributions till at least age 18.
That's correct.
So that's making it a long-term investment. So
Right.
people don't get into it. And
Yeah.
if you leave it longer than that, obviously these kids could have huge retirement accounts for themselves.
Yeah, it's good. It starts an account out really young, which is fantastic. They can't be aggregated with any
Right.
other IRA.
Yeah.
So that'll
It's
be
always going to
interesting.
be separate.
It's always going to be separate.
Yeah.
So
Now, does that preclude anybody, like if they did a $5,000 Trump account and maybe did their own contribution for their child, that doesn't preclude them from doing an IRA for themselves? That had nothing to do with that.
no, not that I know of. Not that I know.
And no income
No.
limits, right? I think anybody that would just when you're born is the big thing
Yeah.
here.
It is when you're born.
Yeah.
Yeah, when you're born.
Maybe I'll have another kid.
Yeah.
Sean, I've been trying to get you
Over
to
the
do that.
$1,000.
Yeah.
Just for the
I mean,
$1,000.
and just saving any tax I
It's
can.
worth it.
Right? No, my girls just turned 8 yesterday, and I'm
Yeah. Happy birthday to Quinn and Sloan.
Quinn and Sloan. We'll give you a
Quinn.
little shout out.
Yeah.
They'll be stoked on that.
Happy birthday, guys. So Sean's, I told him, maybe try for another kid, and this is your sign, your opportunity.
Yeah.
Kate, if you're listening, that's going to prepare you.
We'll get twins again, and then what?
And
I don't know if you'll have me in as
Maybe you
advisor
get
anymore.
Trump account.
I'm getting my gray hairs. I've got enough. So,
Um,
all right.
Let's go into some other tax credits. So we're talking now about some other things that maybe have to do with clean energy. So those of you out there buying your Teslas or your electric vehicles, a lot of stuff happening there.
That's me.
Can you
September
elaborate on that?
30th. Yeah.
Yeah, today's the day.
Yeah. So if you haven't bought one by now,
This will be old news
You're
for you.
weird? Okay.
Don't think you can get one.
yeah. Some of the other, that's those are done. Charging stations are going to go out later. Not a big deal. But those are mostly for people that have, Airbnb. What I've seen in my clientele, because we do a lot of real estate,
Mhm.
which means people that have Airbnbs and they want to put a charger in there. That's not going to be. Those are going to go away for them as well.
Interesting.
Yeah. And then the energy efficient home stuff will be going away at the end of the year. So solar
Okay.
is going away, all that.
Wonder how that affects all these solar companies.
Yeah.
I mean, a ton of those in Utah. So
Oh, yeah.
Doesn't it?
that's going to affect them.
I think it's going to affect them big
Big time.
time.
So another opportunity is the SALT deduction that's changed.
Yeah. So that's bumping up to 40, and
Was it 10, right? 10,000?
Yep, 10. So it's 10 to 40 in 2029. It will be adjusted for inflation. We're still going to be using the PTE salt for those that need it, and we do that. We do that quite a bit for lots of our clients, where PTE stands for pass through entity,
Mhm.
right? Where we'll you have a partnership or an S corporation of some sort, and we'll pay the state deduction in the business, right, and deduct it in the business, and then pass the deduction to the personal, obviously.
Mhm.
Then it's added back to the state return, and then it's they have that tax credit on their personal tax return. But we use that for many, many, many clients, so we'll still be using that for some, but it'll go away for a lot of people because that gap between the 10 and 40.
Yeah.
It phases out on that higher deduction, that 40,000.
Yeah.
$500,000
Yeah.
income.
Again, though, I think that's where we bring the salt in, the PTE salt. Sorry. I mean, a lot of our clients, it's one of those false ceilings we've been using, as soon as we got the PTE salt rules in, we just replaced that. with the pass-through entity
Oh.
rules, and then then we're not really worried about the limitations.
Okay.
Yeah.
At all. So
That's a way to
yeah, we
skip that.
Yeah, we call that glassing for like the Roth IRA. It's the same thing. And then we saw that SALT limitation, and then we got the rules for the PT SALT pass-throughs, and now we just kind of move that through instead.
Seems like it just gets more complicated, and there's another loophole
I know.
to dig through.
Everything changes, but then you start figuring out loopholes and
right.
how to work around things.
Yeah.
What about standard deduction? How did that change?
It went up.
And maybe explain that just for our listeners, what the standard deduction is, how it changed, and what it means for them.
Yeah, the
Yeah.
standard deduction, you get that up until you have your itemized deductions like, state and local tax. I'm sorry, SALT means state and local tax.
There you go.
We didn't say that.
Yeah.
And then, those taxes, mortgage interest, which has changed a little bit, but, you have medical expenses after your 7%, income limitations. All those things can go up over the 31,500 this year for joint. And that went up slightly again. We'll go up for inflation now.
Yeah.
Right. Which is nice.
So if you don't itemize up to that 31,000,
You automatically
you're
get-
taking the standard deduction, which went up
Absolutely.
a little bit.
Yep. Correct.
Yeah.
Yep. And it's now adjusted for inflation. So
And it wasn't before.
but it just changed with the
Yeah.
tax law.
Personal deductions and the child deductions, did those change at all?
Well, the child tax credit went up a little bit.
Child tax credit.
$200.
Yeah, that's what I should have said.
Yeah, not a ton, but
Yeah.
if you're getting it, then it helps. Everything helps.
About tax on tips, that was a big running point, right, in the election.
Yeah.
And there's seems to be a lot of misconception around it. I see the posts on Instagram all the time, and I'm always wondering, like, what's the truth? So you're our guy. Tell us the truth.
Yeah, so we've this has actually bounced back. The U.S. Treasury bounced back. They had proposed regs out there, and they bounced back 2 weeks ago, maybe a week and a half ago, actually. That they said they're going to restate them. So we don't know exactly how they're going to bounce back, but we kind of know that it's the first $25,000, right?
Mhm.
They came out with, they're going to be coming out with, and we'll see if this changes. I don't think it will, of which specified service and trades or whatever, the service industry, which ones will be applicable for that. And the same with the overtime,
Mhm.
which is the same thing, What we have heard is the IRS said the Treasury will have a separate box on your W-2 now. So there was a little bit of a different box on the W-2 for it, but for overtime, we're thinking another box also. We were using, of course, those tip boxes a lot for tip credits for our restaurant clients. We're
Mhm.
getting tip credits, but now there'll be deductions up to $25,000, which is quite a bit.
Yeah. With some income limitations, right?
With some income limitations. Yeah, 150,000 single, 300,000 joint.
So once they hit that 150, then the cash just goes in the pocket, and they don't.
You
remember
can't
to
deduct
report.
any of
Can't
it.
deduct any of it.
So it's no phase outs. It's just gone.
Just yeah. Mhm. No, I'm
That's
sorry.
what I'm saying.
There is a phase out, but it's not very much.
Okay.
I mean, has there ever been a study that asked the question, how much of your tips are actually reported?
Yeah, it's
Do you
true.
report them all?
Well, the crazy thing is my restaurant clients, they have turned the corner years ago about reporting tips because of the tip credits.
Mhm.
I have certain restaurant clients that don't pay, that takes a giant chunk out of their tax.
Yeah.
Yeah.
Because they're properly reporting tips. So on their tax return, they don't, they get this giant tip credit, which helps them out a lot.
Well,
Yeah.
the comments that we wanted to ask about the small business tax breaks.
Yeah. I mean, we get to keep the QBI, which is qualified business income deduction, which is 20% of the net income. We see a little bit in our some service industries that we call them SSTBs is what we call them.
Mhm.
Specified service trader businesses that, that have limitations on these, but there's a lot of people that take advantage of them. Yeah. And you can do we'll do the optimization with your wage versus net income, as it gets higher to take advantage of that deduction. Cause it can be quite nice. 20% net income.
I may or may not use it.
Yeah.
So,
man,
yeah.
You're supposed to be a contractor.
Actually the code section 199 little a was just contractors and manufacturing. Big A made it so it's for everybody. So yeah, when that was changed, you don't need to be a manufacturing company or a construction company anymore. Yeah, because it's generally you just have the phase outs for the specified service trader businesses now.
What's your rule of thumb? And this is for all of our business owner listeners out there. Rule of thumb for setting your salary or your wage versus taking your draw, so to speak.
That's a good question. Now, what we do at my firm is somewhat a little bit different than other people. I use kind of a 5 parameter system I run through, and one of the things that we're getting hit is, remember that the IRS, one of the traps right now is they've moved a whole bunch of auditors from income tax, from the the small business self-employed, we call it SBSE, the small business self-employed auditors, to this officer comp arena. So in Ogden alone and in Salt Lake, we're seeing, these new auditors coming in and being trained, and they're hitting officer comp. They're hitting it very heavily. And we're seeing, I've done more officer comp audits in the past year than I had in the past 10 years.
That's what they're cracking down on right now, huh?
Right. And, this comes back to OB3 also. They're trying to narrow in on how this one big, beautiful bill had some changes in fringe benefits. And that comes into this officer comp issue, because anything that they can call a fringe benefit, they can say, well, it's still a deductible expense, but now it's going to be a deductible expense for the business as a W-2 wage for the owner, which is utterly ridiculous. So we're having this issue of what that is, but we'll build in, our 5 compliance, withholding, to take care of all of the income, the withholding, Social Security planning on the back end, making sure that Social Security planning is taken care of. And then we, kick it back to you guys for Social Security planning and the retirement. So we'll, deal with you guys on that back end, 401k, cash balance, whatever you guys have going on the back end has to match up. And then we'll maximize it again for the QBI, the qualified business income deduction, because that can be 50% of the wage or 20% of the net income, whichever is less.
That's what their stated rule is. That's
Yeah.
just kind of a guideline.
That's how the credit, that's how the deduction works.
So let me ask you this. So if you have a client, let's say this person, the business owner, he's got $1 million a year, but he takes a $50,000 salary, and then to avoid all the payroll taxes, he pulls out, $800,000 in a draw, or just as a capital distribution.
Sure.
Is that a red flag for the IRS?
If you asked me 5 years ago, I'd say, not really, but if you asked me today, I would say yes.
Yeah.
Because when I'm seeing what the local IRS officers are dealing with, the RA revenue agents are telling me, they're really going after that 100%. And
the penalty is just from the payroll tax standpoint. Is that what they're looking at?
no, not just that. So when they come in on an officer comp audit, they're going to try to get you up to the max Social Security, right?
Yeah.
Is what they're going for on any officer. But that's not it. When they hit that, they're pulling those for a reason, and they're going to go after people with those low officer comp that have less than the max, that have more net income. But I'm also seeing that they're looking for people that you did not give 1099s to that you were supposed to, right? And that you would owe a penalty of 23% of whatever you paid them. So this is very low hanging fruit, right? This is very low hanging fruit for the IRS. So let's say they've come up with, they show that you've paid out, I don't know, $300,000 worth of people that were supposed to get a 1099. That's quite a bit of money, for them at 20.
And you don't have anything to back that up. No documentation.
Yeah. If you don't have a 1099 that's issued for that person, and you don't have a W-9 saying that they were a corporation or some reason why they weren't given a 1099, then that's where they're coming after that low hanging fruit. So they're using officer comp to
find it.
And then they're going after those issues. The officer comp issue is one thing. And I've settled a couple of these recently, one was just a financial planner that I've done work for many, many years, and he had a low salary, and they're going, I've seen them in our local area. They're going after financial planners and real estate agents.
Hang on now. We have knock on wood.
Yeah,
Okay? We don't
Yeah. No, but that's what I've seen. Real estate brokers and real estate agents.
Yeah.
Those are the audits that I've done. So I don't know why they're concentrating on those particular industries, but that's where our officer comp audits are headed right now. But they're going after, I'm not sure. When I was in an appointment, and if you ever want to hear one of a transcript, because I record all of mine with the IRS.
Smart.
Um, very, very interesting what they're going after, but they are going after those 1099s. And one of them did make a comment that the administration really wants to nail down undocumented workers. Well, undocumented workers that are being paid and not given a 1099
Mhm.
are part of that group. And so if you're going after those, that's the impression I got, is they want to knock down undocumented workers, which is people that are being paid and not given a 1099.
That's a good point.
Basically under the table. They're
Yeah.
getting paid under the table and not reporting.
Well,
it.
not paying taxes but still trying to deduct that.
Right. The business owner's
The
taking
business
that
owner,
deduction
right.
that goes out, but
Right.
then no one's claiming that as income.
Right. So
Yeah.
so these audits for officer comp, right, are leading back to that. And so they're really targeting these small wages to pull in multiple factors.
What can be done if a business owner, I mean, and we're not having to name names here, obviously, but if a business owner has some undocumented employees, because there are a lot of, agriculture service businesses that do.
Absolutely.
Let's be honest. What can be done to protect yourself in that case? Can these employees get some sort of a tax identification number to be more legit that way?
Yes, they can. I mean, realistically, to protect yourself, get a W-9 on file, issue the 1099 with the information you have in front of you. That's how you protect yourself.
From that point, your hands are out. You did what you could.
you need
Then it's on your.
Then it's on the person
that's
collecting the money. If you want to cover yourself, get the record. Have them give you that W-9 in the driver's license. Get it on file. And so if the IRS ever comes and asks, you send them that documentation. And as long as you send them the documentation, them committing fraud on you is not on you. It's on them.
Good way to protect yourself, all you listeners out there. So, I mean, sometimes I think we just get a little lazy, or maybe think we're doing them a favor by saying, well, I'm not going to report it, so therefore you don't have to report it. But if you're going to deduct it, you're essentially reporting it, and you better have some
duck
faith
in a row.
Yeah, you better have it lined up. And I'll even say this for our horse owner listeners out there or anybody that pays people that are in that industry. So whatever it might be, from a horse trainer to
ranch hand,
veterinarian, ranch, horseshoer, we're starting to learn right now that it's important to have those documents on file. So get your W-9, get the information that you need for those folks, have their tax identification number. So when you do issue your year end or K1 or whatever you're going to issue, you're going to have it in, you're going to have it for your records on your tax return.
100%.
What other questions? Let's go into the estate planning a little bit, because I don't know how much you deal in estates, but obviously the lifetime exemption and the amount that a family can pass on is greatly increased in this. What are some of the things that you're still looking at for those folks who are maybe in that particular range on the estate?
Jumping to 15 million single, 30 million is pretty big.
Yeah.
It wipes out a whole nother section of the population that doesn't need to worry about it, which is really nice.
Does that carry on until 2029, or did that revert back? Do you know?
I don't know if that's perpetual.
I thought it stayed permanent. I could be wrong.
I don't think it's sunsetted, and I can check on it. I actually don't know if that sunsets or not. I would, with everything else going on in this bill being permanent,
wouldn't doubt
it that it's just going on. So we'll find out on that. But
when we say those numbers, 15 million and 30 million, we're referring to basically how much someone can pass on without paying inheritance tax, or death tax was a common term for it. So if you're single, pass on 15 million, married couple, pass on 30 million, which is, like you said, huge.
Quite a bit.
Mm-hmm.
And then we get into the spousal exemptions and all that kind of stuff that goes on. But yeah, when it comes down to it, 30 million is a big number for most, and 15 million is for one person is quite a bit.
Yeah.
In this, I don't know. I mean, the biggest issue I see in this arena that we deal with on a daily basis and every single year is that people don't realize they can go over the gift amount. I'll have people that want to pass on wealth, while they're living, and they don't have to pay gift taxes if they do it correctly.
They think they can only pass on the 19,000.
Yes,
When
exactly.
actually you can still use this 15 or 30 million. Just
Somewhere
file
in
the
a
gift tax
lifetime
return.
exemption.
Right. Yeah. So yeah, you go. So that's what a lot of people don't realize is that I had one client this year that gave $2 million for a down payment on their son's home.
And they thought they couldn't.
Great down payment, right? But we filed the tax return properly, with him and his wife, and we were able to give that to the son, and you don't pay gift tax on it, but it does reduce the amount of the
lifetime
15 to 30, right? Yeah. So it'll come off the end, and there are, max caps on that as well per year. So you got to watch those. So that's one of the biggest things we see that people don't realize that we do quite a bit of.
Yeah. $2 million down payment. That's a nice home.
It's nice
overall.
Yeah, exactly.
Tahiti, What are some of the small things that people can do as well, and some of the, I don't know, just everyday things that people can take advantage of, kind of things like we're typically recommending if you qualify for a Roth and you're in a Roth IRA, make contribution to a Roth. Maybe think about a 529 plan for kids or grandkids and start eliminating the IRS or the government from the involvement in your future growth of those accounts. Are those things that you'd still recommend, and anything change there?
Yeah, yeah, I do. Me personally, I'm a huge believer in qualified accounts, and the backdoor Roth is we the Form 80, we call it Form 8606 on our side because we have to deal with the tax forms, but on your side, you're giving to those Roths on that glass ceiling. But yeah, I think that's a massive issue, and building in a trader business to maximize those qualified plans is always, in my opinion, a great idea. Reducing that taxable income at your time in your life when you make the most money, makes a lot of sense. But yeah, the Roth IRAs, of course, absolutely. Yeah, always.
I think another misconception we get a lot is I make too much to do a Roth. And you're probably right if you're at those income levels, a Roth IRA, but oftentimes we're seeing, and it's very, very common for a company to offer a Roth 401k, which the income limits do not apply. So you can still put some after-tax money, which becomes tax-free money in retirement. So don't get those two things mixed up, because we do see that sometimes where people think they can't get any money in a Roth.
And if you have the traditional IRA, maybe start thinking about doing some conversions of that, little by little, piece by piece, especially if you have the money outside of the Roth to pay the tax as you convert it. And the longer you have, the longer it can grow, the more the benefit actually becomes applicable and becomes relevant. The longer you have, the more powerful that becomes. So think about those things as well. Let's talk about some of the things people have tried to do, or you've heard about over the years, and you've been involved in this business for 31 years, but what are some interesting things people have thought they could do from a tax deduction standpoint? You had to advise them or correct them in their line of thinking.
Well, that list is huge, obviously, right? Really, what we I try to, with my clientele, we really try to educate with, and I just tell them there's only one code section I want them to memorize. Code section 162. And that is, if it's ordinary and necessary to create revenue or operate your business, and that's a very paraphrased, the definition, but if it's ordinary and necessary to create revenue or operate your business, it's deductible, right? And so make sure that if you're buying something for your business, you need to prove that it's a 162 expense, right? Which is which meets those terms. And so, some people are like, well, can I go buy a truck? Can I go buy this? Remember that there's a lifestyle purchase and there's a business purchase, and those can be the same thing. And that's okay. There's nothing wrong with a lifestyle purchase being the same as a business purchase. If you have something that is ordinary and necessary to create revenue or operate your business, and that happens to be a 3,500, 1-ton truck or a 2,500 or whatever, and you want to deduct the whole thing, that is your prerogative. You can do that. But would you ever go out and spend $100,000 just to save $30,000? No, not really. It doesn't really make any sense. But if you're going to,
I don't know, Jay. We've
Yeah.
seen that a lot.
Well,
Not saying it makes sense,
no,
but
but-
people start thinking, I do need that new
Yeah,
truck.
well, and that's why I say lifestyle issues are another thing, right?
Right.
And I tell my clients that too, that just because it's also a lifestyle issue doesn't make it wrong, you know?
Mhm.
And so, but if you're going to spend, I'll have say, some of my people in construction, well, I'm going to go buy another Traco. And I'm like, well, do you need another
need
Traco? Because if you're going to go spend, $500,000 on a Traco, do you really need it? Well, he's like, no, I already have one. I already have like 6. I'm
Yeah.
like, well, why do you need, will a 7th give you an ROI, or return on investment? Well, no, not really. I just want to do it for the
Just
tax deduction.
That
Then don't
burn
do
to,
it.
to write that 60,000 to the IRS. We're not going to do it. I know.
So I'd rather, there be an ROI involved, right, in the
Mhm.
asset that's purchased as a 162 to invest back in their company.
Mhm.
I'd rather it be a lifestyle, decision, and that's fine too. And that could
Yeah.
also be a 162. But I always push my people to say, well, I'd rather you keep the money and get the deduction, which would be the 401k, cash balance
Right.
plan, the different things in that nature that
Yeah.
you can hold the money. You don't lose the money. It's still yours.
And it grows.
And it grows, and you got the tax deduction for it, right? And so those are always nice.
So that's
Yeah.
that's a really big comment. And I just think it's important because so many of the business owner clients are traditional, and we work with a lot of farmers, good old, guys and gals and people, salt of the earth, but they don't believe in investing stuff that they can't see and touch. They want to buy the land, they want to buy the tractor, they want to buy the trailer, the truck, buy more cows. I mean, and they could be buying at all-time highs, knowing full well that the price might be dropping, but that's where they're going to plow their money into. So in other words, they lose all their liquidity by putting into more illiquid assets just to get the tax deduction that saved them that percentage of that income, not all of it, but percentage of that. And then they have a depreciate in a lot of cases, especially these trucks, trailers, that they depreciate any equipment like that. It's not going up in value.
Right.
So there's the trade-off. Like, would you rather set up a 401k plan or some sort of retirement plan?
Set up a simple, there's a
Put
lot of
yourself-
options out there.
Think
Yeah.
about that.
Yeah.
The money goes in, you get the same deduction, but you see that thing over 10-year period grow. And then you still have the liquidity if you needed it to pull from and draw from over time.
It's always a smarter move. Always a smarter move.
Yeah.
To get the deduction and keep the money.
Brilliant. It sounds simple. But
Yeah.
yeah, but the market's going to crash, Billy. It's going to crash. How long have you heard that? And it still continues.
Been doing this for 28 years. I don't know. Some people you just can't get through to. The frustrating folks for us are the ones who either do stuff like that or they're so locked into bank types of investments that they won't look outside of that. So they're going to stay investing in just savings. I mean, really, really bad things like savings and checking accounts. And sometimes we're talking multi-million dollars in that. And what we've seen over the last 5 years or so is inflation, that's raged, and it's completely destroyed anything that you had just sitting in a coffee can for sure, or the bank, which is pretty much interchangeable. The
Purchasing powers.
purchasing power declined substantially in the last 5 years. I mean,
Yeah.
darn near by 30%. So if you look at it from collectively over that period of time, and you haven't made at least 4 to 5% on average, you've actually treaded water, even went behind in
Yeah.
your investment purchasing power. How things have changed in the accounting industry.
That's a big question.
That's-
Yeah,
that's
I
a
mean,
double-sided question.
yeah. I mean, I've seen things change a lot over the last, 31 years. But I mean, my particular clientele, I've always just dealt with small businesses. I am picking up more and more people that are not just small businesses, but high income earners. Out of state high income earners. Most of them I pick up out of the California area. That are coming in and they're buying, short-term rentals in this area. And my name's spread around like the San Francisco area for those reasons, just people picking up those types of things. But one of the things that's went away, came back, and I always warn people a lot is the issue of with my clientele, because there's so many of them are deal in real estate. And so this big, huge trend towards cost segregation studies, most people out there, I hear them just say, well, everyone should do on every single property a cost segregation. That's actually not true. I mean, it can come back and bite you pretty hard. And I guess those of us who have lived through it know, that in the early 2000s, cost segregation studies were really big. We did a ton of cost segregation studies in the early 2000s. And then with 2008 hit, people had to liquidate, the amount of properties that weren't bringing in the rental income like they thought had to be liquidated. And then a lot of tax bills were paid for those. One of the differences now are the corporate style DSTs that are out there that people are going to. But that is something that went away in 2008, has made a huge resurgence, and it's been a one size fits all that it's really not. That's kind of the biggest thing we see these days. But on the back end, we deal with so many people in that real estate market and the real estate development market that now there's a huge push to go, instead of that DST market, to go with that local move out of a 1031 exchange, right? But it gives the chance for you guys as the planner to step in and give them a little bit more help on the back end, with all those types of transactions. And so working with you guys and, and planners in dealing with those types of situations are becoming more and more prevalent in our everyday practice. So that's something that we're seeing more and more over the past couple of years.
There have been quite a few let's say newly created ideas. I'll just call them ideas because it's a generality, but high net worth people are trying to get larger tax deductions, and some things we've found are like very sophisticated from the tax standpoint, but they're still being implemented. And I wanted to get your take on some of these things.
I've seen this selling a product for a tax deduction. And that's, I think, the difference between you guys and some other planners that I've strayed away from over the years, because I've been doing it for long enough. And, I was securities licensed for 19 years. So I kind of know the game and how things are done inside of it a little bit. And I think, when we look at those things, it's the ROI, right? If it doesn't return your investment properly and it's giving you a great tax deduction, then it's just good money.
I could have bought you a racehorse and got you the same. I'd have a lot more fun.
Yeah, exactly. Yeah, get some enjoyment out of it, right?
Enjoy it.
I know I had fun
you're
with
gonna-
my racehorse experience.
Yeah.
Well, and that's where we go back to. If you're going to do something and it is deductible, then, make it a lifestyle choice. Make it a lifestyle choice that you're going to enjoy, that meets 162 deduction, and not
just setting that to an oil field out there for solar panel in the oil field and never get to see it. Well, it's not very much fun.
And we see intangible drilling costs is the big one we see on those energy K1s that come in. And K1s are the reporting instrument from the LLCs or the LLPs that come in. And those back end intangible drilling costs that come in are a great deduction, but does that ROI match?
Make sense.
Does it make? Yeah. And one of the biggest complaints I see of those is that all of a sudden they'll show income after the 5th, 6th year, and the income on the K1 isn't as much as they're being paid.
Right.
And so let's say they show that they have to pay tax on $60,000, and this is in the 6th, 7th year, and they've only been distributed $30,000. They're like, well, why do I have to pay tax on 60 if I only got 30? And I'm like, well, that's how
it works.
So
we've had clients ask, if I sell that investment, but I keep it in the account, I don't need to pay taxes on it, right? And that's another one of those misconceptions. If you sell something for a profit, the IRS doesn't care what you do with it. You made a profit. You can bury it in your backyard. You can use it to go on a vacation. You can give it away, but you actually have to record that profit and pay capital gains tax on it. So some things I think people misunderstand with regard to the tax game. And that is also, you can't deduct things just like, for example, giving money to one of your kids. A lot of people think I can deduct that.
Right.
Yeah.
I hear
No,
that all
you
the
can't.
time.
Actually, you can't. Are they an employee of yours? Well, no, they should be then. I don't know. Hire them. But a lot of funny things that we see in our world of financial planning. We love working with accountants that know what they're doing. Jake's certainly one of them. He's a straight shooter, not going to lead you astray and feed you full of a bunch of baloney. I think we need guys like that, and we appreciate working with people that are going to give them good advice, not just because I've even seen some accountants, be honest, that they have a sales reward in kind of promoting a certain type of
Tax strategy.
You know, that
Sure.
you know, they get a backdoor commission on a certain product, and that's unethical at a minimum. But I think people need to be concerned and pay attention to what they're doing. If you're planning everything out around getting a deduction and you don't consider all the other factors of your liquidity, your long-term investment gains or losses from that strategy, and how it impacts your lifestyle.
Yeah.
I mean, all those things need to be considered. It's not just I get a deduction and then what? So be smart with what you're doing.
Jake, before we let you go, how do people find you?
I'm in integrated tax in South Ogden.
Okay. Phone number?
Integrated.tax. And
Easy.
Yeah. 801-479-0100. Yeah.
That's perfect.
Pretty slick.
Yeah.
There you go.
Yep.
Anybody out there, holler at Jake if you have any tax questions. And certainly, as you all know, reach out to us if you have thoughts or comments on this show. Thanks for joining us today, everybody. Take care.
Thank you for listening. For more information about today's show, please check out the show notes. Visit our website at www.petersonws.com or give us a call at 801-475-4002. Peterson Wealth Services is a registered investment advisor. This is a paid-for advertisement. Information presented on this program is believed to be factual and up-to-date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of a personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Peterson Wealth Services.